One stock in our portfolio has surged 110% this year, and the entire portfolio of value stocks is beating the market by 5%. But how do you find these undervalued stocks to buy? How do you know when's the right time to buy in before the bounce? I'm digging into our 2019 dividend value portfolio to show you exactly how to find these unloved stocks ready for big returns. We're talking investing in value stocks today on Let's Talk Money.
Beat debt, make money, make your money work for you, creating the financial future you deserve. Let's talk money.
Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. So if you've been following our 2019 Stock Market Challenge portfolio, you know I'm all about that deep value and dividends. I picked 10 dividend stocks at the beginning of the year to beat the market, and they haven't disappointed. Our portfolio is up nearly 25% to mid-September and is beating the market by nearly 5%. Now that's the S&P 500 market index in the green here with 19.8% return year to date, and then the Vanguard Dividend Appreciation Fund in red, both falling short of the 24.5% return on our dividend portfolio. So I'm using this video as a monthly update to our dividend stocks portfolio, as well as to reveal the critical elements I look for in finding these undervalued stocks ready to jump. And if you look into the portfolio here, you see a lot of these have done just that. You've got Hanes Brands with 110% bounce since January. General Mills is up 67%, and 7 of the 12 names are beating the market. Now, some of these stocks were deep value when I bought in, while others were more for dividend and diversification. What I want to do with this video is, instead of just doing a recap of the portfolio, I'm going to be going through some of these investments to explain why they bounced higher like they did, and how to use that to find undervalued stocks for your own portfolio. So I'll be using real-world examples of these 5 keys to investing in value stocks. Now I'm putting this video into our 2019 Stock Market Challenge playlist, so if you haven't seen those other updates in the playlist, check those out. Along with some of the biggest investing channels here on YouTube, I created a $1,000 portfolio in January, and I'm going to be tracking it all year long. To track my portfolio of dividend stocks, I'm investing $1,000 on M1 Finance, a no-fee platform that lets you pick your stocks and automatically invest any new deposits across the group. So I'll leave a link to the playlist of videos below in the description. I'm also going to leave a list to the current portfolio of stocks in the description below as well, so make sure you check that out. Now our first example here is Hanes Brands, ticker HBI, one of the first stocks added to the portfolio in January and surging over 110% in February before I took profits. I wanted to point out Hanes Brands first because it demonstrates one of the most important ideas when you're looking at these undervalued and these deep value stocks. Now looking at the chart of the stock price, you see that HBI had been falling since 2015. In fact, shares had fallen 65% to the point when I added the stock to our portfolio, and it boomed higher. If you're going to be investing in these deep value stocks, besides all the other factors that we're going to talk about in this video, you have to find a catalyst that's going to send the shares higher. It's not enough to be a good business or have good management or good fundamentals. There needs to be some news or financial event that's going to shake the stock from its drops. So I found that catalyst in the activewear growth rates and direct sales numbers while looking over the Hanes Brands financials in December. Activewear is growing at about twice the rate of the broader apparel category, and the company has seen stronger profitability as it shifts more of its sales online. Now I knew it wouldn't be long before the rest of the market saw this and picked the shares back out of the bargain basement prices. Now you're going to be able to use these other 4 factors that we'll talk about to pick great stocks, investments that can provide solid returns. But I want you to keep this in mind when you're using the ideas and investing in a stock that's been falling for a while. You need to find that catalyst for why the market's going to start betting on the company again. Now General Mills, ticker GIS, is another one that had been falling for years before rebounding 67% this year since adding it to the portfolio. General Mills is a great example of something I like to look for in undervalued stocks, increasing sales and improving profitability. It's a lethal financial combination that turns anyone betting against the stock into dust. And this one is particularly effective when you're looking at companies that have just made a big acquisition, so buying another company to boost their sales. In February, I pointed out that the company's acquisition of pet food brand Blue Buffalo as a big boost to its top line sales. U.S. pet food sales have been growing at about 5% annually over the past decade, way above other food sales, so this acquisition was really a game changer for General Mills. But what happens to most companies when they make these big acquisitions like this, profitability just goes out the window, at least for a few quarters. You get this new company and it's all got all these expenses, so management is basically trying to run 2 companies at the same time. Now a lot of times, and this is what happened to General Mills immediately after the acquisition last year, is that investors are just disappointed at first at that lower profitability. Sales were increasing, but net income or earnings wasn't increasing as fast because of those higher expenses, and the shares just plunged because of it. Now in February, I saw that management had a plan to boost profitability, so we were going to see those higher sales and higher earnings numbers come through. It was only a matter of time before the numbers came through in an earnings release and brought investors back to the shares. But this idea of that double whammy from higher sales and profitability doesn't have to only happen after an acquisition, and this is one of the easier factors to look for because you can screen for it on any online stock investing platform. You can use a stock screener to find deep value companies with revenue and operating margin. So that's the profitability measure that you want to be looking at for this. So these two numbers that are increasing on a year-over-year basis. We still got 3 more factors I use to find undervalued stocks, but what do you look for in the theme? How do you decide when to buy a stock for your portfolio? So I'm always looking for new points to analyze and pick stocks, so scroll down and tell us in the comments below. ConAgra Brands, ticker CAG, was a later addition to the portfolio, but one of our best performers with a 50% return since February. Now this is another great example of when to buy undervalued stocks, when to get in after the shares have been dropping. So shares of ConAgra have been falling since the company closed its acquisition of Pinnacle Foods in October. Again, that idea of disappointment in a big acquisition. But the stock saw just a massive exodus in November and December of last year when the integration just wasn't looking as smooth as people expected. So here we are in the historical price data on Yahoo Finance, and this is a stock that was seeing around 4 or 5 million shares traded a day. When the price first started falling, it was pretty modest, and the trading volume didn't really increase much. But then around an earnings release, the shit just really hit the fan, and investors bailed on the stock. All of a sudden, you had tens of millions of shares trading a day, and investors all tried to sell at once. 19 million here on the 20th, 23 million shares traded on the 21st of December when the shares dropped 24% in just 2 days. Now this is what's called a capitulation event, and it's a great signal to watch for with these undervalued stocks. What happens here is that even as the stock price starts dropping, there are still investors holding on and nobody's really panicking. Then you get that massive exodus with the stock price plunging on extremely high volume of shares traded. All the pessimists and even some investors that were on the fence about selling or buying sell out of the stock. So this creates a bottom in the shares, a point where only the long-term buy and hold investors are left. All those low conviction buyers have sold out and the short sellers are dominating. In effect, there's nobody left to sell the shares. This is the point that any good news, any catalyst that we've been looking for has the chance to move the shares higher. Looking at ConAgra in February, it looked like management was being overly conservative on its estimates, and I knew that we had a catalyst when the sales and profitability numbers turned higher, and that's what we got in that March earnings release that took the shares booming higher. Now I want to use Bank OZK, ticker OZK, as an example for our next factor, a best-of-breed company in its industry. Whenever you're looking at these undervalued stocks, looking at investments that you think should rebound, you want to be buying the leaders in the industry. Now we call these companies best of breeds, the companies with exceptional management and assets that just dominate against their competition. Bank OZK has 251 branches, mostly in the Southeast and Texas, and has been named the top performing bank in the country for 8 consecutive years. Just about every measure here, from return on assets to return on tangible equity and non-performing loans, 2 very important bank measures, are all better than the industry average. Now when I added the shares to our portfolio, they traded at a price to book value of just 0.76 times. So shares traded for less than the book value of the bank and about a third the average of the industry. So what we had here was a leader in its space trading for less than competitors. And you don't have to be a numbers nerd like myself to understand that's a pretty good deal. Finding these best-of-breed companies isn't really that tough. You're going to be comparing some of the financial data for the company against its peers. So some numbers you want to consider including here is how fast the company is growing sales each year, maybe the operating margin, which is that measure of profitability. You can compare the return on assets, which is just the net income from the income statement divided by the average total assets on the balance sheet. Investing in these best-of-breed companies means even if you're a little early on the investment, if that catalyst for higher stock prices doesn't come immediately, you still know that you have a quality company that's going to rebound eventually. Now our next stock, the Vanguard Real Estate Fund, ticker VNQ, is up 27% this year, which is even more impressive considering it's a fund of hundreds of stocks. So up to this point, we've really talked about the analysis at that company level to pick those value stocks. The real estate fund is a good example, though, of looking at that bigger picture, the overall economy, to see which stocks might shoot higher. So looking at slower economic growth for 2019, it was a good bet that the Fed was going to start cutting interest rates. The trade war with China was just starting to heat up, and momentum from those tax cuts was already slowing. Now, that diversification you get by adding real estate to your portfolio makes this fund a buy in itself. But I saw the bigger picture here, that developing economic environment, and started looking for investments that would do better in that falling rate scenario. With high leverage in real estate, falling rates are a double benefit because the companies get a lower cost, but you also get investors pouring into the trade looking for those higher yields. Now, that's driven that 27% gain on the fund this year, more than double the historical annual return on the investment. Click on the video to the right here for my 5 favorite high dividend stocks ranked for best cash yield and total returns. Don't forget to look in the video description below for that first video on how we set up our 2019 Dividend Challenge portfolio and how to get started with dividend stocks.